we'll talk about how to replicate mutual funds with just a couple of clicks, and how to do that for free effectively. Make My Fund is India's first personalized equity investing platform, and that allows you to actually invest in equities just like you would invest in mutual funds, but at a fraction of the cost and with complete control over your investments. Just a couple of bookkeeping things. I'm just checking if everybody is able to hear me clearly. Yes, seems like we're on track. So let me get started. A background to this work is our general philosophy at Make My Fund and ASCII of reducing the cost of investing, because that's become a very major component of total returns in the recent years. And in the West, this is already taken off as the so-called indexing and smart beta revolutions. And in last 10 years, 9 out of 10 years, active mutual funds have lost AUM despite decent returns. And passive mutual funds, indexing and smart beta ETFs have gained AUM. Part of the reason behind this trend has been the high cost of active investing and relatively muted performance. In India too, we are starting to see that. So we are seeing performance at par with indices and a fees of 1-2%, one for regular direct plans and 2% for regular plans, which erodes the overall performance significantly, as we'll see through the presentation. Today's webinar is about how to replicate your favorite mutual funds without having to pay the mutual fund expense ratio. And a platform like Make My Fund enables that. So that's what we want to discuss today. Quick pointer about Q&A. Why we'll have the Q&A at the end of the session. We would encourage participants to put in their questions in the chat window through the presentation as well if they have any questions. So it becomes a more interactive session. And we'll obviously take all the remaining questions towards the end as well. But just in case you have a question which pops up at the time of a specific point being made, please feel free to write it in the chat window. So with that, let me begin. So, as I described briefly in the introduction, expense ratios have become very important. Why is that? Because if you look at a 15-year window, the mutual fund returns are almost 10-12% at most. In 10 years, they are better, but in 15-year window, they are actually worse. And in the long run, we can't be expecting 15-20% returns from equities. It will probably be closer to 10 to 15%. Now, when we used to make 18-20% in equities back in 2007, 10, 11, 12, thereabouts, the 2% fees of mutual funds didn't bother us so much. But now, if the CAGR over a multi-year window is, say, 10-12%, suddenly 2% becomes 20% of the expected returns. And that's a sizable number, as we'll see subsequently. Second thing, which is a more structural trend, and it's not a temporary phenomena, is that mutual fund outperformance, when we say vis-a-vis the indices, is actually falling. So it's a well-known phenomena in the US and Europe markets that mutual funds, on an average, underperform the benchmark. Why is that? Because market is relatively efficient. So you have some top-performing funds or some underperforming funds. The average is roughly at par with benchmark pre-fees. You take out the fees, it's always below the benchmark. And people have a counter argument saying, we know our good funds and they'll perform well. It's been proven in the West that, year after year, you can't use the historical performance to see the future outperformer. So they tend to average out over the long run. So given this relative expectation that mutual funds will perform at par with benchmark, maybe slightly better, and expense ratios are a big component of mutual fund performance, and hence your wealth building plan, it makes sense to actually pay attention to how to reduce the expense ratios. Now, there's a third big trend, which is equity returns being falling. We talked about that, how we are generally used to taking 15-20% as the norm in equities, and mid-cap used to go as high as 20-25%. Last several years have taught us that it's actually closer to 10-12%, just as it is in the West on the equity side, when you take a sufficiently long window. And it makes sense then to actually look after your returns on a net basis, which is why it's important to pay adequate attention to expense ratios throughout. Just as a side tangent, last time we talked about tax, which is also an important thing. Now that long-term capital gains tax is non-zero, it's at 10%. In a 12-13% tax regime, returns regime, you pay about 1.3% to 1.5% in tax, about 1.5 to 2% in fees. You're essentially paying out almost 3% in taxes and fees alone. If there is a way to reduce both of these components to nearly zero, you can improve your returns by almost 3 percentage points per year without taking on extra risk or without trying to do something extra with your stock selection and so on. Last time we covered tax optimization, how to reduce 1.5% of your taxes each year in terms of your returns on portfolio. This week we'll talk about how to reduce your expense ratio by close to 1.5 to 2%. Let me check if there are any questions. No. Great. So next point is, how much is this 2% worth really? Because we are used to thinking in big numbers, 20%, 25%, 30%, or even 15% for that matter. So what does it matter if 2% is just, you pay 2% to someone and they perform well? What's the downside? One might ask. But compounded over a long period of time, this becomes significant, as this slide shows. I won't go through the numbers specifically, but suffices to say that in a 10-year window, you could actually do as much as 30-40% in simple terms. If you have a 10 lakh rupee portfolio, it can be 4 lakh higher because you save 2% each year over the 10-year window. And what is crucial is, in general, we are talking about performance, right? So XYZ fund outperformed the benchmark by this much and something else has underperformed and so on. All of that is uncertain, variable. You don't know whether this outperformance will continue. You don't know whether equity markets themselves will continue to perform. But what is certain is the cost. Cost and taxes are certain and known. And if you can reduce a certain element like cost, you have to be less dependent on the outperformance of the mutual fund. So you no longer have to worry whether your mutual fund will outperform the index or not, because you've brought down the cost so much that even at par performance means you are going to build wealth sufficiently strongly. So in a 10-year window, it pays to reduce your cost. That's the limited point of this slide. So how do you do that is the next question, right? Till recently, it wasn't really possible if I wanted to replicate a mutual fund portfolio, because it is very cumbersome, to say the least. Technically, we do have the access to mutual fund portfolios every month, but one has to, as a retail investor, if one were to replicate that, one has to sit down and actually manually go through it and then invest accordingly. But let's talk about how it's feasible in the first place, even at least theoretically. Then we'll go about the mechanism of it, right? So especially in the recent quarters, or in fact recent months, SEBI actually came out with the order that mutual funds have to publish their portfolios every fortnight, not just once a month. So now, in a public domain, all of us have access to the mutual funds holdings on a fortnightly basis. And one may claim that, what about the fact that mutual funds will sell and buy during the 15-day period? Mutual funds have become actually pretty large in the Indian context. If a large cap fund these days is as much as 10,000 crores. Now, that sort of fund is not going to actually sell or buy a stock in a day. Because even if you think about 2% of the 10,000 crores, talking about 200 crores. You're not going to be able to sell 200 crores of a typical stock in one shot. And even if you do, there'll be a big price fall if you're trying to sell, or if you're trying to buy, then a big rise, so-called impact cost. So in general, mutual funds, sensibly so, spread out their buying and selling. So even if the portfolios change, they're going to change over a longish period of time, not over a single day. Secondly, many mutual funds take pride in the fact that their churn is low. There's a different reason for that, but let me not get into that in too much detail. Suffices to say that they are trying to essentially replicate the index. Index itself doesn't change a whole lot, so why would you change your portfolio? But that aside, whatever their claims are, one thing is true, is that they don't change the portfolio dramatically from 1 month to next or one fortnight to next. So there's a certain stability to their portfolios, and changes are relatively small. It's rarely so drastic as to just exit a stock completely or enter a new stock in a big way. Everything is gradual. So if something was 4% last fortnight, this fortnight it will be 3.5% at most. It won't be zero, and vice versa. A new stock suddenly is not going to make 5% of your mutual fund portfolio. It will realistically be 0.1, 0.2%, will gradually inch up as the performance stabilizes. So Our claim here is, and we'll support it with a definitive process in the next slide. If the portfolios are known every fortnight and they're relatively stable, a savvy investor can use this publicly available portfolio of his or her favorite mutual fund and invest in the same stocks, not pay any fees. Now, that means, and you actually get to then do this with 0% expense ratio effectively. We'll still pay brokerage, but these days the delivery brokerage is so low, it doesn't matter. And more importantly, you pay it only once, as in once you invest, and let's say you do it over 3-4 years, the brokerage is paid only once, and then small churn that happens throughout the year, which might be 5-10% of the portfolio. That's a very low cost in the brokerage sense also. So your net costs actually are close to zero over a 3-4 year window. That's a dramatic saving for carrying out replication of a portfolio, which is relatively straightforward. So lots of ifs and buts here. One can actually say the logistics of this is going to be far more complicated than what meets the eye. There are no two ways about it. We are agreeing with the fact that it's cumbersome, but this slide is essentially to say that it is feasible. In the next one, we'll say how to actually, what's the mechanism behind it? How do you actually go about doing exactly that? So let me go through that process as well. Now, most mutual funds have about 50 to 100 stocks in their portfolio, which is a good thing. Diversified portfolios are good. And if you were to, and one may rightly ask as a retail investor that, if I were to do it myself, it will be so prone to errors because I have to do it every month, and then I actually have to check what changed, how much, and so on. And the obvious answer, which mutual funds haven't embraced, and the financial services industry as a whole has been a bit slow in adopting, is automation, right? So if you have a technology solution which does this for you, so because we are not claiming that we have a whole army of analysts sitting and sifting through mutual fund portfolios week after week or month after month. All of this is automable because it comes in very structured format. Everything is so precisely known and structured that it's very easy to track it if you write the right set of proprietary algorithms for it, which we have done. So now we have automated systems which check the mutual fund portfolio month on month or fortnight on fortnight, figure out the differences and point out the changes, right? That's one part of the technology. Second part of the technology is how do you actually then enable investors, individual investors, to invest in this? That's where the Make My Fund platform becomes relevant, which is now that this portfolio is known, how do you do a one-click investing in it? Because technically, I can send you the portfolio or we can send you the portfolio and you can essentially take it to your broker and say, invest in it. But there'll be 50 orders if it's 50 stocks. Whereas we are talking here about one-click execution. How do you enable that? So that's the process described here. So first is log into your MMF, which is Make My Fund account, if you will. Just to be clear, we don't require you to open a new broking account or new account, demat account or anything of that sort with us. We are a SEBI registered investment advisor, and all you need to be doing is have an investment advisory agreement with us. But your own broker and your own broking account, online broking account, that is what you work with. So you log into the MMF portfolio, MMF account of yours, which is easy enough to create. You can create with a Google ID. The portfolio is displayed. So we'll go through this process in demonstration as well, but just highlighting the broad strokes here. A portfolio will be displayed. So you essentially pick your fund, which is Axis Large Cap or top HDFC Top 200 or whatever it might be. And the portfolio is there. You don't have to take our word that this is a portfolio. You can also double check in the early days that, does it match what the fact sheet says? It will match because that's the same source we're using. And you just have to do one click invest. Now, when you click invest, you essentially go to a selection of brokers. So we have tied up with a gateway infrastructure provider, which gives you access to 10 brokers from Zerodha, HDFC Securities, IFL, Edelweiss, Upstocks, anything, basically. So you don't need a new account. You just go with your selected broker and log in with your account with that broker, execute the trades. That execution is also one click. You don't have to then manually select each stock. It already is displayed. The order is pre-sent and pre-prepared. All you need to do is have the sufficient balance in your broking margin account or broking account to fund these trades. So if you're buying a lakh worth stocks, then you need to have a lakh in the account and so on. But once you have that, it's not entering 50 trades. It's just one click. It's already sent to the broker after your login with the full portfolio ready. And so when you say, okay, at that point, the order goes to the exchange. If it's a working day or working hours, there's an exchange hours that will get executed immediately. You can even do it on a Saturday, Sunday, in which case it will be executed on the first opening, which is Monday morning. So that is the first step, right? Now, one may ask, this is fine for the first time investing, but mutual funds will keep changing their portfolios month on month or fortnight on fortnight. How do we keep track of that? Again, you don't need to do it. We obviously keep track of that. And when the portfolio changes, it essentially triggers a rebalance for you to whatever small extent. So let's say you bought 1 lakh worth stocks, which are replicating ICICI Pru large cap fund. Now, in that replication, iPru's portfolio changed by, say, 5%. And some stocks were bought, some were sold. So that rebalance is triggered from our side. And again, it's a one-click rebalance. When you come to the your account, look at the portfolio, you don't have to manually look at it. The email we send you will anyway straight away take you to that point where you just approve the rebalance. And it again takes you to the broker. You put in a login password, and the orders are pre-loaded. They get executed, and your portfolio is back on parity with the favorite fund's overall portfolio. So the investment as well as the rebalancing is both automated fully. It's one click because we want you to retain the control over what you invest, how we rebalance, and so on. And there is full transparency because those stocks actually be lying in your demat account. They'll be in your control. You can eventually sell them partially, fully, as you wish, independently of the Make My Fund platform. You can just go to your broking account and sell it directly as well, should you choose to. But that's the level of transparency and control that exists. Right now, we're doing this for free. In future, we may add a small fee to it, but nothing more than, say, 0.25 or something. But that's far in future. Right now, we just want to democratize investing, and we want to bring down the cost of investing by essentially enabling solutions such as this. So right now it's free. In terms of portfolios available, it's basically all the major funds. We keep adding to that, but all the major funds will be there, and enables you to do this then as you wish, multiple funds, one fund today, one fund tomorrow, and so on and so forth. So you can build whole portfolio of funds using this approach. And they're all, interestingly, they all sit in the same demat for you. So all of that is in one place. So that, I guess, is in a nutshell the presentation. I'll walk you through the actual demo of this, because that's the proof of the pudding is in the eating. Before that, let me check the questions. None. So let's quickly look at the actual execution of this. Palak, I'm just checking. Are you able to see my screen? So as you can see on the screen here, it's essentially a few portfolios which were shown for the demo. And so it's essentially these 5 I've just shown for the sake of demonstration. Let's look at Axis Blue Chip Fund. Look at this portfolio now. HDFC Bank, Bajaj Finserv, Infosys. This is how Axis Blue Chip Fund is in real life. You can double check that. So all of these are essentially its components with various allocations. Now, when I say invest, it'll ask for the amount. Now, this is just a demonstration, so I'm putting a small amount. This takes me to the gateway. So now these are the brokers we have, which essentially is 10 brokers. Edelweiss, Zerodha Securities. Most likely, majority of investors will have account in one or more of these anyway. So my own personal account is in Zerodha. This is my account. So I'm just logging in now. So see this obviously is a small portfolio, so it was just 3 stocks. When I review these orders, place these orders, today is Saturday, so it obviously won't get executed today, but it is sent to the exchange, as in it's sent to the broker, and it is going to be executed as and when the markets open. So that's simple. I essentially went to the whole process in a 3-4 second window. So that's really the power of doing this without actually having to pay the expense ratios with mutual funds. That in a nutshell is, and this obviously the broader Make My Fund platform, which allows you to do a lot more things beyond replicating mutual funds. But in this webinar, we're talking about just replicating mutual funds. Hence, we talk about that. This specific platform, we're happy to have you visit it, give us feedback, try out other things that exist here, which is smart beta, ethical investing, thematic investing, goal-based investing. But suffices to say that that in a nutshell is what today's webinar has been. Now, I've got a couple of questions. There's one fairly drastic question saying, are we running charitable institutions? Short answer is no, we aren't. We are essentially keeping this free for now so that you get comfortable with it. But later, the idea is not to charge you like 2% for it. It's essentially our main portfolios on Make My Fund, Smart Beta and so on, which has nothing to do with mutual funds. They are also charged at 0.25% only. And also first 3 months are free, so you can still experience and decide. So yeah, eventually the mutual fund replicators will get charged 0.25% per annum, which is a tenth of what mutual funds charge normally. So yeah, it's not charitable, but it'll eventually get charged. Question is, are we able to take parts of certain mutual funds and replicate that only just power sector? It's a very interesting question. So let me just first flip this. So we can do that. In fact, the current Make My Fund platform is designed to do exactly things like this, which is how do you optimize a portfolio within a sector, or how do you exclude a certain sector? Both are possible. So this is a useful feature to add. We currently don't have it, which is, can you take Axis Blue Chip Fund and say, I want to use only BFSI sector of Axis Blue Chip Fund? Short answer is our platform enables that. In fact, we want to enable even the next thing, which is to say top 5 mutual funds or your selection of top 5 funds. You put them together yourself from a selection of drop downs, and then say in these 5 funds collectively, let's just get these 3 sectors and exclude these 4 companies. So all of this personalization is exactly what Make My Fund is meant to do. So short answer is possible, not today, but we make it feasible if that's a feature which everyone values. MFs don't incur tax on churn. Is that an advantage for them? Yes, short answer is it is. But this advantage has come down quite a bit in 2018, since 2018. The reason is back then, short-term capital gains tax was 15, long-term was 0. So the MFs had a big advantage because on churn, they didn't pay any taxes, and on the long term, then they did. In this case, it's 15 versus 10. So it's not dramatically different, because if you pay tax on churn now, after a year, when you do exit it, it will be only on that extra portion, which could even be negative or so on. So that's first part of the answer. Second part of the answer is that there is a subtle benefit to replicating a mutual fund, which is not possible if you buy the fund directly. It's as follows. If you replicate a mutual fund and you stop liking that fund, say 1 year later, you say, Axis Blue Chip is now become a laggard. I don't want to invest in it anymore. I want to now invest in ICICI Prudential or large cap fund. If you had to do that using actual funds, you'll have to exit Axis Blue Chip Fund and purchase ICICI Pru large cap fund. On Make My Fund, through this replicator platform, you don't have to actually sell all the stocks that are there in Axis and buy all the stocks that are in ICICI Prudential large cap fund, because 70-80% of the stocks are similar, and the holdings are also likely to be very similar. So if Infosys is 4% of Axis, it will be 3% in ICICI large cap, and if HDFC is 6% here, it will be 4% there, some variation of that sort. So your churn, even when you exit the fund, can be significantly reduced. So if you have 1 lakh, which has grown to 1,20,000, or you have 10 lakh, which has grown to 12 lakh, and that point you sold from Axis to ICICI in a direct world, as in the mutual fund world, you'll have a cap gain stacks of 20,000 on the 2 lakh gain. If you did that on this replicator platform, you'll actually have cap gain stacks on a fraction of it. So because you're only changing, you're not selling everything, buying everything new. So you're just switching from one fund to another in its replication. So the 2 lakh gain, you will not have realized all of that. You may realize only, say, 50,000. Your tax actually comes down to 1/4 of it. We can keep doing this for many years. We don't have to ever exit it fully. So next question is this only for investors, or can RIAs also harness a platform? Short answer is the mutual fund replicator itself is, well, technically it's more for the end investors, but our overall platform, Make My Fund. So let me give a quick overview of that. Make My Fund platform itself can be used by RIAs just as well as it can be used by end investors. So let me just quickly show the platform itself. So here, for example, if you're an RIA, you can say, I want to build portfolios for my customers. So I'll build a highest return portfolio, which is not using mutual funds, using stocks directly. So I figure out my selection of factors, my universe, whether it's top 200, my portfolio size. I can even exclude specific sectors and all that here. I check how it has done in the past in terms of performance. I like the performance, and I actually go ahead and build a portfolio. I look at the stock portfolio. I like it enough, then I sort of go ahead and save it. So, and so on and so forth. So you can actually save these on your individual Make My Fund accounts, and then share them with your, so let's call this RIA 1. 50,000 is fine. Let's be saved it. So you can invest. Well, if you're an RIA, probably you won't invest. You want to show it to your investors. So you essentially just go to dashboard and say, okay, I have this portfolio now. These are all my personal portfolios. This RIA portfolio we just created. This is my portfolio that I can, returns anyway, it's just invested today, so no returns. I can download this and share it with my investors. And there are also things we're enabling here, which right from your own account, you can share it with your users. With your customers, so it becomes straightforward. You can bring your customers also on our platform and tag them as your customers and share portfolios only with them. And they can copy your portfolio, meaning they can follow your portfolio, and we can figure out the suitable fee sharing based on your arrangement with your customers, transparently on three parties concerned. Hopefully that addresses your question. Okay, let's look at the next question. Direct mutual funds also have the same expense ratio? No, they don't. Direct mutual funds have 1% expense ratio. We are talking about 0 now and 0.2, 0.25% in future. So 1/4 from direct and 1/10 of regular. Small case is similar to this replicating. Small case is essentially a marketplace for small mutual funds. So on small case, people have to trust the third party as well as small case platform, right? So you are essentially signing up not for a small case created platform, you're signing up for a portfolio created by some hopeful RIA known to you, but not small case itself. Unlike that, we are proposing these portfolios ourselves. We are a SEBI registered RIA. We do stand behind these portfolios, and you are a client of ours. There's not a third party involved which you have to trust blindly. Replicating MFs is one of the features. What small case doesn't allow is personalization. It's a take it or leave it. It's like mutual funds, but small mutual funds, which could be unique, interesting, but still they are like ready-made. Whereas in our case, you can personalize it to any level. You can even say, I want an ethical portfolio on top of this. Such personalization is for sophisticated investors, they understand. So small case is targeting relatively less savvy investors who just want to invest 5,000-10,000 rupees here and there, pay some 100 rupees and get on with it. We're talking about sophisticated investors who are looking to do something more concrete with their portfolios and for whom cost and taxes matter, which is what we're trying to say. For RIA portfolios, what is the rebalancing frequency? Can we do same on demand rather than monthly? If you're referring to the MF portfolios, then that will be driven fortnightly, as and when the MF portfolios are published. But for portfolios that you create, which are smart beta portfolios or thematic portfolios, We also have a monthly or even more frequent rebalancing frequency feasible at the back end. We just have to make it available to the front end. Rebalancing is up to you. I mean, it's on demand, ad hoc also, as well as regular. So we can do both. Foreign stocks. It's an interesting question. So we've been figuring out how to go about foreign stocks. Some MFs actually have foreign stocks as well. So short answer to that is today it's not possible, because we're talking about replicating Indian holdings of mutual funds, which is anyway 99% of them. So those holdings can be replicated immediately. In future, in a manner similar to Grow, for example, we are trying to create a portfolio for investing in overseas stocks and ETFs directly from Make My Fund. In which case, you can, just as you can build a smart beta portfolio of Indian stocks, you can build a smart beta portfolio of US stocks. The worry here is not our research. That's anyway done and dusted. So that's easy. And not even the algorithms. That's also easy for us. It's the regulatory landscape. It's very complicated to do LRS, especially through a online approach. So that's what is holding us back a little bit. But we are bringing it on board soon enough. How expensive the fund manager are divided into regular plans is a question. So, well, typically regular plans are 2%, 2 to 2.25%. And the direct plans tend to be half of this, about 1%, 1.2% or so. And just to repeat earlier point, we are close to 0.25%. So that's the comparison. Can I get some more contact details as our follow-up questions? Yes, you can write to us here. I'll write an address here. ascii.advisors@ascii.in. So I put it in the chat window. ascii.advisors@ascii.in. Great. So Sanjay, I have noted your question. I'll take it offline and write to you directly. If you can send us your email ID, that'll be useful. We will have it from the webinar registration, so we'll take it from there. Okay, I have a couple more questions. Balance funds also invest in debt. Will that also be replicated? Yes. Short answer is they will be replicated. To the extent that, so debt, unlike equity, is harder because the markets are not liquid. So the balance funds are investing in GSEC and AAA rated quasi-sovereign debt, then that's easy for us to replicate. But of course, the connected question is the investors will have to have a login with the broker. They'll have to have the debt market login also, which is different from your equity market. So the login is same, access. You have to have RDM access, which is not so hard, but you still need to enable it. It's not automatic. So typically, people open an equity broking account. That's essentially just their primary account, which is NSE, BSE stocks for delivery and intraday. They don't have derivatives, commodities, debt, etc. So you need to enable a couple of these. Within that, yes, it is possible. But it's fair to say that it's primarily for equity funds, not so much for balanced. Yeah, I think Mr. PT, we have got your contact details. We have noted those. ICICI Direct broker, is it supported is the next question. As of now, it's not. We're working with another gateway provider. So we have one gateway provider, we're adding one more. The second one has ICICI Direct also as a broker. So I think we are about 2 to 3 weeks away from it. Nothing longer. So by the end of April, we'll definitely have, mid of April, we'll definitely have ICICI Direct as well. Is there any recording of this? Yes, we are recording this as we speak. We're going to put it up on our YouTube channel, which is also the previous webinars, which talk about Make My Fund as an overall platform. So you can look at that besides the the mutual fund replicator we talked about today. Channel link. Just give me 10 seconds. I'll share the channel link to our YouTube channel as well. So I'll have to figure out how the exact mechanism is, but I'll share the link with you through an email just now. It's ASCII.advisors, but I think somehow I'm not able to get the exact link here. Okay. Great. So I think that's all the questions we have for now. Sushant, I will get back to you with the channel link. We'll share with you and everyone else as well. So thank you again for attending this webinar, and we look forward to hearing from you on your feedback and hopefully improving the product with it. Please feel free to reach out to us with any questions you may have about this as well as about Make My Fund in general. Thank you so much. Melvin, to your last question, how many funds currently replicated? We have about 75, 80 of them, and we'll keep adding to it constantly. Great. Thank you so much, everyone.